Are you still struggling with your trading, testing new strategies and not getting the results you like? Lucky for you, in this video, I'm going to be teaching you one trading concept that is going to help increase your accuracy and make you a more profitable trader. In today's video, I'm going to be showing you how to use supply and demand and how to use it to identify high probability setups. I promise you that you are going to learn everything you need to know about supply and demand in this one video. There will be no need to spend hours researching this topic by the end of this video because I am going to teach you everything that you need to know about supply and demand. So starting off with, what is a demand zone? A demand zone is an area of buy orders that the market has left unfilled. This happens as a result of the market aggressively moving to the upside, which leaves those orders unfilled. As we can see in this example right down here, the market made a sharp move to the upside, leaving orders unfilled down here. Price returns down to the area, fills the orders, and makes the next move up. As a result of this aggressive move up, this leaves an imbalance in the market and is an area that price will likely retrace to, which we can use to our advantage to look for a low risk long entry. Now, how do we identify a high probability setup inside of the demand zone? When price is trading inside of the demand zone, there are three steps that you want to look for. The first one is going to be the impulse move. You want to look for a large aggressive move away from the area. As previously mentioned, this leaves orders unfilled and can act as an area of support the next time price comes to test it. Second is going to be price action. We need to identify buying pressure inside of demand. Once price retraces into the demand level, watching price action is going to be key. Since this is an area of support, we want to look for bullish price action. Bullish hammers, dragonfly dojis, bullish engulfing candles, as well as long lower wicks going into the demand level. Step number 3 is going to be gauging buying pressure with volume. If those orders are being filled inside of demand, you're going to start to notice larger than average volume. Now, let me show you how to draw a proper demand zone. So when it comes to drawing these demand zones, you need to look for what is known as a basing candle. Now, the basing candle in a demand scenario has to be a red candle. So what I look for is a smaller red candle before a strong aggressive move up. So this red candle right here would be a basing candle. This red candle right here would be a basing candle. This red candle down here would be a basing candle. Even right here, this red candle would be a basing candle. So again, we need to have a smaller red candlestick before a very large and aggressive move up. If it's a green candle before the large aggressive move up, it does not count. Now, as far as time frames when drawing demand zones, I use it on a variety of different time frames. I like to use the 1 hour, the 2 hour, the 4 hour, daily, weekly, monthly, sometimes even a 45-minute, but most of the time it's going to be on the higher time frames such as the 1 hour and higher. So looking at the 2 hour time frame on NQ, we have this nice red basing candle right here before a large aggressive move to the upside, leaving orders unfilled down at this area. So when drawing your demand zone, what you're going to do is you are going to mark the low point of that red candle, and then you're going to mark the open of that red candle. So this is going to be your demand zone right here on the 2 hour. For this example over here, again, we have that red basing candle before a large aggressive move up. What you would do is mark the low of that red candle and the open of that red candle. This is the area that you want to watch for a potential bounce for demand. So going back to this 2 hour demand zone over here, again, we want to mark the low and we want to mark the open. From there, you're going to take your rectangle and you're going to go ahead and you're going to fill in that area with your now demand zone. So now as a result, you know that you want to watch 16694.5 down to 16657.75 for a potential bounce on demand. Now, if we head on over to the lower time frame on NQ, notice what happened when price traded into the demand level. It went down into demand, it picked up the buy orders, and it had larger than average volume with a nice bullish candlestick to the upside. This, as a result, is a confirmation to go long with your stop loss right below this low right here. So that's how you're going to be able to identify your demand zones. Again, you want a small basing candle before a strong aggressive move up. It has to be a red candle before the aggressive move up in order to be demand. If it's a green candle before the large aggressive move up, it is not demand. Start playing around with different time frames and see if a different time frame offers a demand level at that area. Now that you know how to identify demand zones and how to find high probability setups inside of those zones, let's start discussing supply. What is a supply zone? Supply is an area where the market has left unfilled sell orders. This is the result of an aggressive impulsive move to the downside, which as a result leaves orders unfilled. This creates an imbalance in the market and price will likely retrace back up into this area. And since we know where that supply zone is going to be, we can look for price to come back up into it, look for a rejection, and look for a low risk setup to the downside. And just like demand, there are 3 steps that you want to look for before entering the position short. First, we need to have a large aggressive move to the downside, which again, as a result, is going to leave those sell orders unfilled. Second, we want to watch the price action and we want to look for bearish price action inside of the supply zone. And then third, we need to look for heavier than average volume, which is going to reflect that sell orders are truly being filled inside of the supply zone. Now, when looking for supply, we want to look for a small green basing candle before a large aggressive move to the downside. So looking at NQ right here, we have this small green candle before a strong sell-off down. And we have another one right here before a strong aggressive move down. So both of these would be considered a supply zone. So when drawing these zones, what you want to do is you want to mark the high of that green candle and you want to mark the open of that green candle. That is going to be your supply zone. In this scenario down here, you're going to mark the open of that green candle, but because the high of the red candle is higher than the green candle, you're actually going to go ahead and you're going to mark the high of that red candle. These are going to be your supply zones, and when price trades up into it, you want to watch the price action and start to look for bearish price action, heavier than average volume, which is going to confirm that sell orders are being filled. As we see right here on the NQ futures, there is a 2-hour demand zone right here. Breaking it down and watching price action intraday, it comes down, it tests the demand zone, larger than average buying volume comes in with a nice bullish candlestick. From there, you would look to get long and you would set your stop loss right below this low right here. And then from there, I would typically look to at least get a 2-to-1 risk to reward. So risking about $850, I'd look to make about $1,900. You could even aim for high a day, which would be around 2K, but we'll look to put the take profit right there. And as we can see, price starts to continue to push up slightly. And then from there, it goes up and hits the take profit zone right there, resulting in almost a $2,000 gain. Now taking a look at the ES futures for a supply example, we have this supply zone right here. So we're going to take the high of that red candle and we're going to mark it to the open of this green candle right there. And that is going to be our supply zone. And we want to look for price to trade up into this area to potentially look for rejects. And as price trades up into the area of supply, you then want to start looking for a rejection. And then from there, once price rejects and you look for that confirmation, you can go ahead, you can go short, depending on where inside of that supply zone price begins to reject and confirms your entry. You'll simply place your stop loss right above the high. So price comes up, it tests the supply zone, look to get short. And because you're risking around $100, you want to look for a minimum of a 2R on this trade, which would be around $200. We're just going to go ahead. We're going to place this a little lower. And then immediately after price rejected that supply zone, price dropped about 6 points, which was around a $325 take profit. And then from there, you can see price goes ahead, it hits the take profit and goes a lot lower. That's going to conclude this video on supply and demand. If you guys did find value in this video, definitely make sure to smash that like button as well as clicking that subscribe and that bell icon. It would mean the absolute world to me. We're getting super close to 70K subscribers. I appreciate every single one of you. Everybody have an amazing rest of your day, and I'll see you guys in the next video.